Most people think they're diversified. They are actually holding a bag of ticking time bombs. 2008 was subprime mortgages. 2025? It is going to be different. The recession that is coming won't destroy the assets you expect. It is going to obliterate the ones you thought were safe. Because while everyone was panicking about interest rates and inflation, 7 asset classes quietly became financial black holes. Traps designed to look like opportunities. And in 2025, they are going to detonate. And the number one asset on this list, it is being marketed to you right now as recession-proof. It pays double-digit yields, and it is about to implode. Let's start with number 7. Asset number 7, regional mall anchor retail space. Let's start with something most people don't even think about owning, but if you're in a retail REIT or a commercial real estate fund, you already do. Regional mall anchor spaces. The big box stores, Macy's, JCPenney, Sears. Oh wait, they're already dead. Here's the fatal flaw nobody talks about: co-tenancy clauses. When an anchor tenant goes bankrupt, every other tenant in that mall has a legal escape hatch. They can break their leases, slash their rent, or simply walk away. And in 2025, we're watching the second wave of anchor bankruptcies hit. Party City just collapsed. Bed Bath & Beyond is gone. More are coming. When that anchor dies, the entire mall enters a death spiral. Foot traffic craters. The remaining stores invoke their co-tenancy rights. Suddenly, landlords are stuck with 1 million square feet of empty concrete in a dead suburb with no anchor, no tenants, and no buyers. These properties aren't distressed, they're extinct. And if you own shares in a fund holding these assets, you're about to watch your NAV disintegrate. Asset number 6, 2020-2022. Vintage used luxury EVs. Now let's talk about something sitting in driveways across America right now, quietly losing value faster than any asset on this list. Used luxury electric vehicles from 2020 to 2022. Tesla Model S and X, Audi e-trons, Jaguar I-Paces. Here's what the dealers don't tell you. Battery warranties are expiring. And when that happens, you're not driving a luxury car anymore. You're driving a financial liability. Battery replacement costs range from $15,000 to $25,000 on a car that's now worth $30,000. Do the math. Depreciation on these vehicles is already hitting 60 to 70% in 3 years. But 2025 is the inflection point where degradation meets warranty expiration. Suddenly, buyers realize they're one battery failure away from financial catastrophe. The resale market is evaporating. Dealerships won't take them on trade. Private buyers are running. This isn't gradual decline. This is thermal detonation. And if you bought one of these thinking you were saving the planet and your wallet, you're about to learn a very expensive lesson about the hidden costs of early adoption. Asset number 5. CLOs tied to over-leveraged private equity buyouts. Let's get sophisticated for a minute. Collateralized loan obligations, CLOs. Wall Street took a bunch of corporate loans, mostly from private equity buyouts, bundled them together, sliced them into tranches, and sold them as safe investments. Sound familiar? It should. This is 2008's playbook with a new acronym. Here's the fatal flaw. Those loans are coming due in 2025, and the companies behind them are zombies. Private equity loaded them with debt in 2020 and 2021 when rates were zero, then paid themselves massive dividends and walked away. Now those companies can't refinance because rates are still elevated. They can't sell because nobody wants over-leveraged garbage, and they can't generate enough cash flow to survive. The CLO market is a $14 trillion time bomb. Investors were told these were diversified and safe, but when defaults start cascading, and they will, these safe investments are going to get marked down by 30, 40, 50%. And the retail investors holding these in bond funds and pension plans won't even know what hit them until the statements arrive. Asset number 4. Suburban office to residential conversion projects. Office buildings are dead. Everyone knows that. So developers had a brilliant idea. Convert them into apartments. Suburban office towers transformed into trendy residential lofts. Sounds genius, right? It's a disaster. Here's why. Conversion costs were wildly underestimated. developers projected 12 to 15 million for a mid-sized building. Reality? 20 to 25 million. Why? Because offices weren't built for residential. The plumbing is wrong. The HVAC is wrong. Floor plates are too deep for natural light. Zoning requires complete redesigns. Every step costs more than projected. But the real problem is timing. These projects are finishing in 2025, just as apartment supply is flooding secondary markets. Migration trends are reversing. Remote work is stabilizing. Demand is cratering. And now, developers are sitting on expensive new apartments in markets with rising vacancy rates and falling rents. Pre-construction investors who put money into these deals expecting 15% returns are about to get nothing. Projects will stall, developers will default, and the money is gone. If you invested in one of these suburban conversion deals thinking you were ahead of the curve, you weren't. You were the exit liquidity. Asset number 3. Tokenized real-world asset crypto projects. Let's talk about the hottest narrative in crypto right now. Real-world assets, RWAs, tokenized real estate, tokenized bonds, tokenized everything. Finally, crypto has real backing, right? Wrong. Here's the fatal flaw nobody wants to admit. The legal frameworks these tokens claim to operate under don't exist. These projects promise you ownership rights to real assets, property, commodities, securities, through blockchain tokens. But when you read the fine print, you don't own anything. You own a token that represents a promise from a company that may or may not honor that promise. And in 2025, regulators are done watching. The SEC is bringing the hammer down. Courts are ruling that these are unregistered securities with zero legal claim to underlying assets. When that happens, billions in supposed backed value will vaporize overnight. Token holders will discover they have no recourse, no assets, and no way out. The irony is perfect. Crypto was supposed to be trustless. RWAs brought trust back in, and that's exactly what's going to destroy them. If you're holding RWA tokens thinking you've finally found the safe play in crypto, you haven't. You've found the next collapse. Asset number 2. Fractional ownership vacation properties. Platforms like Picasso let you buy an eighth of a luxury vacation home, use it a few weeks a year, and supposedly rent it out the rest of the time. It sounded like the democratization of luxury real estate. It's actually a liquidity trap with no escape. Here's the problem. The Airbnb loophole is closing. Hundreds of jurisdictions are banning short-term rentals in 2025. Vacation towns are cracking down. HOAs are revolting. And suddenly, that fractional share you bought for $200,000 can't be rented out. You're stuck with 6 weeks of personal use and 52 weeks of carrying costs. And it gets worse. There's no secondary market. Nobody wants to buy your 1/8 share of a house in Tahoe that they can't rent and can only use 6 weeks a year. The platforms have no liquidity mechanisms. You can't sell. You can't refinance. You're locked in. Meanwhile, HOA fees keep rising, maintenance costs keep rising, and you're paying your share whether you use it or not. Fractional ownership was marketed as smart diversification. It's actually financial quicksand. And in 2025, thousands of investors are going to realize they bought an asset they can't use, can't rent, and can't sell. Asset number 1, high-yield BDC dividend stocks. Here's the big one, business development companies, BDCs. These are publicly traded funds that lend to middle-market companies and pay out fat dividends. 8, 10, 12% yields. Retirees love them, income investors worship them, and in 2025, they're going to get slaughtered. Here's the fatal flaw. Those dividends aren't sustainable. BDCs are required by law to pay out 90% of their income. Sounds great. Until you realize that income is coming from loans to over-leveraged, struggling companies. Middle-market firms that couldn't get bank financing. Companies that are one recession away from default. And that recession is here. Default rates in BDC portfolios are already climbing. When those loans go bad, the income disappears. And when the income disappears, the dividends get cut, not by 5 or 10%, by 30 to 50%. But here's the real kicker. The stock price collapses too, because the only reason anyone owned these stocks was for the dividend. When that's gone, there's no reason to hold. We're talking about 50, 60, 70% drawdowns in share price, plus dividend cuts. Investors are going to get destroyed from both sides. If you're in a BDC for the yield, you're not collecting income. You're collecting risk. And in 2025, that risk is coming due. 7 assets, 7 traps. And the thing they all have in common is this: they look safe until they're not. The 2025 collapse won't be loud, it'll be quiet. Asset classes will just stop working. Liquidity will vanish. Buyers will disappear. And the bag holders will be left wondering how they missed the signs. The signs were always there. You just had to look. If this video saved you from making a catastrophic mistake, subscribe. Because in 2025, information isn't just power, it's survival. And the assets that look safe today might be worthless tomorrow. Stay sharp, stay skeptical, and whatever you do, don't hold the bag.